Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation.
I'm Jamie.
And I'm Alex. Now, I know many of you are perhaps enjoying a well-deserved festive downtime, maybe trying to avoid that third helping of Christmas pudding.
Hopefully.
But while the high street was, focused on the seasonal cheer, the financial markets ended 2025 not with a gentle slowdown, but with a real shockwave.
A shockwave in the metals market, and it's something that demands immediate attention from anyone involved in UK retail banking. Strategy, risk, compliance, this affects everyone.
So that's the mission today, isn't it? To get past the headlines and figure out the concrete implications of this unprecedented surge in precious metals.
Exactly. We need to look at what this means for things like deposit retention, conduct risk under consumer duty, and, the potential product gaps for high street banks.
Okay, let's get into it because we are talking about really generational moves here. Let's just confirm the scale. When we say surge, how shocking were these headline numbers for gold and silver as we closed out the year?
The word staggering doesn't quite cover it. Gold hit an all-time high of $4,477 per ounce.
An all-time high.
On the 22nd of December. That is a surge of approximately 68% in 1 year.
Wow.
The best performance gold has staged since 1979.
68%. Just to put that in perspective for you, the best high street savings account was offering what, around 4.1%? That disparity alone creates an immediate strategic problem for banks, which I know we'll come back to.
It absolutely does. And then you have silver, which dramatically, and I mean dramatically, outperformed gold.
Right.
It was driven by this potent mix of monetary fear and just surging industrial demand. Silver gained over 130%.
130.
130% year to date, reaching $69.44 per ounce. That's the highest level since the infamous Hunt Brothers bubble back in the 1980s.
And that Hunt Brothers reference is a good marker for volatility, which is precisely what should concern risk managers. So this isn't just market noise. This is a true macro event.
It is.
What are the structural engines driving gold, which some had dismissed as a barbarous relic? Back to the very forefront.
The core driver, really, is the central bank demand floor. The World Gold Council data shows that central banks have bought over 1,000 tons of gold for 3 consecutive years.
1,000 tons a year.
For 2022, 2023, and 2024. That level of persistent accumulation hasn't been seen since before 1967. This isn't tactical buying. It's a structural policy shift.
A shift away from what exactly? Why this sudden sort of coordinated move?
It's a strategic geopolitical de-risking. They're diversifying reserves away from assets that carry counterparty risk, and that means U.S. debt specifically. You see this with reported buyers like Poland. They accumulated 90 tons in 2024, Turkey with 75 tons, India adding 73.
And then there's the China opacity problem. Analysts strongly suspect Beijing's buying is, vastly understated.
It's the elephant in the room. Officially, the People's Bank of China reported just 44 tons in 2024.
Which is still a lot, but
based on UK customs data and other import tracking, analysts estimate their actual accumulation could be closer to 570 tons.
570.
If that's true, it suggests China is rapidly building sanctions-proof reserves. Their true holdings could be well over 5,000 tons. This relentless demand, it provides a very sticky price floor.
It reinforces this idea that gold is now insurance against a fracturing global financial system.
Exactly.
And here's where it gets really interesting for risk modeling in UK banks. This breakdown of established correlations. Historically, gold was supposed to be the opposite of a safe bond, right? If U.S. real yields go up, gold, which yields nothing, should fall.
That relationship has completely collapsed. It signals a genuine regime change. Historically, that correlation was strongly negative, around minus 0.73.
So they moved in opposite directions.
Always. But gold surged 68% in 2025, despite real yields being at their highest since 2007. Since 2022, that historical inverse correlation has just flatlined. It's clocking in near zero at plus 0.02.
So if gold isn't acting as a hedge against rising rates anymore, what does that tell us about its fundamental pricing mechanism? How does a bank redesign its treasury hedge book based on this new reality?
It tells us gold is now being priced as insurance against fiscal debasement and, geopolitical fragmentation. It's not just a non-yielding bond alternative anymore.
Fiscal debasement meaning?
With U.S. debt approaching $38 trillion, the market is pricing in risk related to sovereign creditworthiness, the long-term stability of the whole fiat system itself.
So gold is fulfilling its function as a neutral, sanctions-proof asset, and this view is now gaining institutional weight.
A lot of institutional weight? The significance of that shift can't be overstated. Morgan Stanley made waves back in September 2025.
What did they say?
They specifically recommended a 20% gold allocation in portfolios. They're moving away from the traditional 60-40 model, explicitly calling gold anti-fragile, and replacing long-duration bonds as a core portfolio hedge.
Okay, let's shift to silver. The real star performer this year, up over 130%. If gold is driven by monetary fear, what's giving silver that extra dramatic juice?
Silver has a dual engine that gold lacks. While gold is almost purely monetary, 59% of silver demand is industrial.
Okay.
That makes it a critical, non-substitutable component of the green transition. And this industrial use has created an acute structural problem in the physical market.
Structural problem how?
Well, the Silver Institute's World Silver Survey projects that silver is in its 5th consecutive year of deficit. The cumulative shortfall from 2021 to 2025 is projected at nearly 800 million ounces.
And the supply is inelastic, isn't it?
Completely. 72% of silver supply is just a byproduct of mining other metals like copper and zinc. So supply just cannot respond quickly to a surge in the silver price.
So that's a classic squeeze. Surging demand, fixed supply.
Yeah.
Only the price can move. What specific technologies are driving that demand side?
It's relentless. Solar PV demand is expected to reach 40% of total silver demand by 2030. That's driven by new high-efficiency cells that actually require more silver paste per unit.
More silver, not less.
More. And on top of that, electric vehicles use 67 to 79% more silver than combustion engine vehicles. It's for electronics, battery management systems. This isn't cyclical demand, it's structural.
Which brings us to the core issue for our UK banking audience. The huge implications for UK retail professionals, especially around tax and compliance, because the UK tax code has effectively created a massive arbitrage opportunity.
It has.
An opportunity that encourages your customers to move wealth out of your institution.
This is the UK tax arbitrage, and it is a direct challenge to the high street savings market. The government has slashed the annual capital gains tax allowance, which currently sits at a mere £3,000.
And that's prompting a flight for tax efficiency. How does gold benefit from this?
UK legal tender gold coins, we're talking sovereigns and Britannias, are completely capital gains tax exempt.
Completely exempt.
Completely. Yeah. Because HMRC treats them as sterling currency under the tax code. A UK investor can buy a gold Britannia, hold it while gold surges 68%, sell it, and owe 0 CGT on potentially massive profits.
That is a direct incentive structure to bypass traditional banking products. I saw in the sources, the Royal Mint's bullion coin revenue jumped significantly.
It exploded. The Royal Mint reported that their bullion coin revenue rose 206% year-on-year in Q4 2024.
Wow.
That is customer assets actively migrating out of regulated taxable savings products and into a tax-sheltered, state-owned, but unregulated asset.
Now let's contrast that with silver, which had the best market performance. What's the tax drag there?
Silver has a punitive tax structure in the UK. Gold is VAT-free as investment gold. But physical silver is subject to the standard 20% VAT rate upon delivery.
20%.
According to HMRC VAT, notice 70121A, this means physical silver has to appreciate by over 20% just for a UK buyer to break even.
Before they even start counting any capital gains.
Exactly. This VAT trap is why the vast majority of UK retail demand focuses solely on gold coins.
So the CGT arbitrage is driving what we're calling this deposit unease migration, actively pulling funds from the regulated banking sector.
Precisely. Royal Mint online bullion transactions jumped 55% year-on-year in Q1 2025. Customers are proactively seeking inflation protection and tax efficiency. They're moving their wealth out of the regulated sphere.
And that raises the most critical issue for UK banks, the FSCS protection gap.
This is a major conduct risk exposure.
It has to be. How should compliance teams be viewing this?
It is the biggest single conduct risk this movement creates. When your customers move deposits to unregulated physical bullion, to the Royal Mint's DigiGold platform, or even to fintech exposures like Revolut Gold, those assets have no FSCS protection
None.
at all. So if prices were to fall sharply, and we remember the historical volatility, especially in silver, customers will suffer losses.
And the regulatory exposure for the bank is that if they offered no warning, no competing regulated product, they are vulnerable to complaints down the line.
Exactly right. Under the FCA's consumer duties, specifically Principle 12, and the rules about avoiding foreseeable harm, banks have a massive gap.
So if a customer withdraws 50 grand from a deposit, buys gold, and loses half of it.
And the bank provided no educational content, no clear warning about the FSCS protection gap, then that bank is exposed to subsequent complaints and significant reputational damage.
It sounds like banks are effectively seeding this whole wealth preservation market, even missing out on tax-efficient opportunities they could facilitate.
They absolutely are. I mean, consider the untapped SIPP opportunity. The FCA designated physical gold as a standard asset for self-invested personal pensions back in 2014.
Which offers up to 45% tax relief on contributions.
And yet major high street banks offer nothing comparable. They were just letting that lucrative, tax-efficient market flow straight to SIPP providers who are partnered with the Royal Mint.
Let's shift to the controversial angle that's giving market critics ammunition for the bubble case. This unexpected massive new buyer who links this ancient asset to modern crypto volatility.
This Tether whale.
Explain this.
Stablecoin issuer Tether has emerged as a sovereign-scale gold buyer. As of Q3 2025, Tether holds a whopping 116 tons of gold.
On 116 tons. That's roughly equal to the sovereign reserves of South Korea.
It is.
Wait, the opaque crypto company bought that much physical gold. That sounds like a speculative pump. How seriously should a UK compliance officer take a buyer who is completely outside the traditional regulatory sphere?
You have to take it seriously because it represents a new price-agnostic demand channel. Tether accumulated 26 tons in Q3 2025 alone.
26 tons.
That's 5 times the amount China officially reported buying in the same quarter. It links highly liquid crypto liquidity directly to the physical bullion market, adding a speculative layer that can drive prices higher faster than traditional demand.
So if we step back, is this a structural repricing, the central banks and fiscal debt argument, or is Tether just fueling a crowded speculative bubble?
That is the central market tension right now. The case for repricing is compelling. The shift is structural, supported by sticky central bank accumulation and gold's new role as geopolitical insurance. That's just the floor is much higher than before.
And the bubble case, what makes this vulnerable?
The bubble case points directly to the velocity. 70% in 1 year is massive, and the elevated speculative positioning. Futures open interest is at its highest level since 2013.
A crowded trade.
A very crowded trade. It suggests speculative excess, and it's vulnerable to a sharp, sudden profit-taking cascade if macro conditions were to suddenly reverse direction.
So what does this all mean for our listeners? What should UK retail banking strategy, risk, and compliance teams be focused on right now, looking into 2026?
First and foremost, the scam threat is rising. Public interest in gold means the risk of fraud is soaring. Data shows 800,000 UK people lost money to investment or pension scams in the 12 months to May 2024.
So increase vigilance.
Banks must increase vigilance and enhance monitoring for unusual transfers to these digital gold investment firms that are frequently popping up on the FCA warning list. That is a core protective role under consumer duty.
And banks can't afford to just ignore this migration of funds, can they? Especially when the tax environment is actively incentivizing it.
Absolutely not. Strategy teams must urgently decide on product adaptation. They can continue seeding the market or they can partner.
Partner with who?
Well, the Royal Mint's DigiGold platform offers clear white label potential, or they could integrate exposure via fintechs like Revolut, which offers gold exposure with a tight 0.25% spread. Ignoring this wealth leakage is no longer sustainable.
And from a compliance perspective, the immediate imperative to manage that foreseeable harm.
Education. It has to be the primary line of defense. Banks must provide clear, authoritative content that explains the CGT versus VAT guidance and, crucially, provides explicit, unavoidable warnings about the lack of FSCS protection for these products.
That's the minimum requirement.
It's the minimum required to manage conduct risk and truly meet consumer duty obligations.
What stands out to me is how this gold surge is really a market mechanism responding to deep-seated geopolitical and fiscal uncertainty. It's forcing UK banks to address an asset class they largely exited decades ago.
They did.
The strategic question for banks isn't about the price of gold, is it? It's whether they can afford to let the CGT arbitrage opportunity and the FSCS protection gap just remain unaddressed.
Effectively outsourcing wealth preservation to a state-owned entity and unregulated fintechs. That's the crux of the strategic failure or, opportunity, depending on how they react.
So we'll leave you with this final provocative thought. The most profound finding of the 2025 precious metals surge is that the UK tax code and central bank policy have combined to make a 1,100-year-old coin, the gold sovereign or Britannia, a more tax-efficient store of wealth for the UK investor than almost any modern financial product a high street bank currently offers.
So the question is it time for banks to develop sophisticated, structured products that can combine the safety of a regulated deposit with the tax efficiency of physical gold exposure?
Something for those strategy teams to mull over during their festive break. Until next time.
Stay sharp, stay informed, and stay ahead of regulation.